Hey, welcome everyone. I'm Ted Earhart. One of the things that I find most interesting about the investment game is the psychological dimension of it. There's so many ways that we can make mistakes, to start kind of basically getting in our own way. And I recently even heard one of the most prominent investors in the world, Jeffrey Gundlach, say, there's 1,000 investment mistakes, and I've made every one at least 3 times. And his point was, no one bats 1,000. It's a really tough game. I want to focus in today on one narrow issue that I think leads to a lot of psychological mistakes, and that's the deceptiveness of investment returns. The inspiration for this video is an interview I saw by a well-known investor, well-known Wall Street guy. His name's Ron Barron. He's been around for a long time and has a pretty distinguished or respectable record, and he's had a good couple years, so he's been in the media more. And recently he was talking about one of the reasons for their success in recent years, and that's their investment in Tesla. You can see Tesla up on the chart. The stock price essentially went parabolic in 2020. But more importantly, Ron Barron in this interview was talking about the fact that they bought Tesla in the mid-20 teens, owned it for 5 years, and the stock price basically did nothing. So imagine that. Holding something for 5 years, a lot of people would give up, but they believed in the strategy, they believed in Elon Musk, and were ultimately rewarded. Well, I bring this up because through my study of many great investors, those with very long track records, what I've found is what we're looking at up here in the case of Tesla is somewhat symbolic of the track records of many of the great investors. You may look at an investment, a long-term record, say 20 plus years, and it shows excess average annual returns. But strangely, what you'll often find if you look at the individual returns every individual year and compare that to the benchmark, in many cases, the strategies themselves underperform their respective benchmarks in at least half, or even in many cases, the majority of years. But the point is, the years in which they create excess performance, it's enough. The performance is oftentimes significant. It's enough to really bump up that long-term average. And I think this really can throw people off. So for instance, let me give you an example. Here's a strategy that I follow quite closely. I won't name it publicly, but it's a concentrated domestic stock strategy. And since inception, which was back in 96, so it's got 25 years of history, same manager at the helm the entire time, this particular strategy has generated annualized average returns in excess of 12% compared to its benchmark, the S&P 500, which is in the 9s. So it's roughly a 3% delta or 3% difference. And that might not sound a lot, but over time it really adds up. If you started with 10,000 in either the strategy versus the index, here's the difference, 175,000 versus 97. So we're talking real dollars here. But here's the interesting thing. Again, when you dissect the numbers, take a look at these midterm numbers, 3, 5, and 10 years. Look, in every case, in all 3 of these medium-term periods, the strategy has underperformed significantly. But if we look most recently, in the latest 1-year period, which is through the second quarter of 2020, we see massive excess performance. We're talking the strategy's basically doubled the market over that time frame. And my point is, again, through my observation of many of the world's greatest track records, this is so frequently what you'll see, is you will see these extended periods of lackluster performance, and then where they're just kind of tracking, not terribly lagging, but then all of a sudden you just have a banner, maybe 1, 2, 3 years, and that is enough to create these great long-term looking averages. But the problem, of course, is most investors aren't really following along. They're not really reading the annual reports and what the managers are actually saying as they articulate their theses and logic and so forth. So people get antsy, if they own something for, say, 3 or 5, even 10 years, it's so easy just to blow out of it. It also reminds me of a number of these hedge funds that correctly predicted the housing bust back in the 2006-2008 time period. A lot of these guys made windfalls for their clients. In the case of John Paulson in the middle, he personally made $1 billion on what's been reported as the greatest trade in history. But in the context of this video, at risk of overgeneralizing, basically all these hedge fund guys have done nothing in the 12 or 13 years since. And by nothing, I mean they've just turned in average, or in some cases even below average performance. But again, that's just in line with exactly what the kind of thesis of my discussion here today is. So frequently, all of the excess performance comes in just these little narrow windows of time. And if you're not patient, it's so easy to miss those and end up with subpar results. So investment returns can be exceptionally deceptive, and there's no perfect solution, but in my opinion, the best way to give yourself a chance, to come to the right conclusion is you have to be following along. If you own individual businesses or if you own strategies, you have to be reading the reports that the people running these things are putting out, because this is where they explain their strategy and the logic behind what they're doing. And it's not a guarantee that things will work out, and it's not a guarantee it's going to tell you precisely what to do, but at least in my view, it's going to give you a much better basis from which to make investment decisions. I mean, if you're just looking at their performance numbers, as we demonstrated earlier, you can go a long time with subpar performance. And in the case of Ron Barron, can you imagine if he had sold his Tesla position after holding for 5 years? He would have missed out on, say, a tenfold return in 2020. And again, that's why it's so important to follow along and know what you own. So I appreciate you following along. As usual, I'm a little bit more long-winded than I wanted to be. But, if you have any questions, or if there's other topics you'd like me to cover, please reach out, drop me an email, leave me a comment. Thanks for watching. We'll see you next time.